To talk more about this data and the impact on the economy, the Fed, and the markets, we're joined by Liz Young, head of investment strategy at SoFi, and our senior markets commentator, Mike Santoli. First, let's get to Steve Leisman for his reaction to the numbers. I was thinking, Steve, remember when we got the PPI and the CPI? They were, none of them were the worst it's been, but none of them were as good as we were hoping for. If you ask ChatGPT or GPT, whatever it is, to forecast this number today, this is what it would have been. I mean, you could have figured this would be it because, and the markets, they're down, but they're not like, oh my God, we're not, the stock sold off another 100 points. As Rick said, a couple of basis points on the 10-year. But it's just, it's crappy news for inflation hawks, but it's about, I think it's sort of where we thought we'd be probably.
So, Joe, it's a bit like, do you ever drive to like the end of a road and all of a sudden the road goes from asphalt to dirt? And you're starting to wonder, boy, should I bail out of this or should I keep going and hope eventually this thing goes back to being asphalt and a smooth road? This is hopefully the bumpy part of the ride. And this is something the Fed officials have talked about. That word bumpy, it was in my bingo card for the minutes. And the question becomes, is this something that, is it on the way up or is this just part of the oscillation as we go down? I think there's a lot of expectation that this is the oscillation part and that the market, to the extent that it had something wrong, it had wrong the idea that we're going to have this linear or smooth ride down in inflation. It's going to go up and it's going to go down. Hopefully the trajectory is still downward. I want to make one other point here, Joe, which is we want to look at the savings rate, which is up to 4.7%. I think that's important because what's been happening is consumers, despite the challenges that they have with higher inflation, seem to be rebuilding their savings here at a time when they still have high savings from the pandemic. So I think this is a decent outlook for the health of the consumer. We're up to 4.7 now. It should be up near 7%. That is, how much of their disposable income are they putting away, or they're spending their income as a percentage of their spending. So it's 4.7. It's on the way up. That's a good sign, I think, for the health of the consumer. And one other point, which is now, Joe, we're at 5.21 for the year-end funds rate. It's up a couple bips on this news this morning.
All right, Liz, get over to you quickly. Do you just take it away, because I know that you have to think about these things. We saw the PPI and CPI. This seems similar, doesn't it? It's a similar flavor.
Similar flavor, yes. And I'll start with something positive, that personal spending is still strong and beating expectations. So anybody out there who believes that the consumer can spend us through this data doesn't really fight that trend. The worrying part of it is that personal spending growth is outpacing personal income growth. So that savings number that Steve just mentioned, probably likely to go down, and or consumers are bleeding out the savings that they had built up before this. And we're seeing some of that in the credit card spending data as well. As for the actual inflation numbers, I want to make a quick distinction so that anybody watching understands what the differences are, because we talk about CPI all the time. PCE is actually a more comprehensive measure of inflation, measures both rural and urban consumers, allows for substitution. So if the price of chicken goes up, you substitute with turkey. That's a more realistic view of inflation. So this is why the Fed watches this particular data point. I don't think this is all that encouraging for monetary tightening reasons. And that's why we're seeing a pretty big correction in the futures of equity markets today, because this just further reiterates that the Fed has to keep going, has to keep it high, and probably has to break demand in order to solve this problem. We can't always have it both ways. And I think that there was an assumption that inflation was coming down at a really good clip. It would keep coming down at that clip. And now we're getting data that it either is going to get stuck or could even pop back up here and there.